Hello friends, in today's video I'm going to share a simple, easy, and effective way to play the pre-earnings run-up with options. Here's what we're going to cover. Number 1, why earning reports provide great investing opportunities. Number 2, where to find a list of companies that are reporting earnings. Number 3, the game plan and what to look for. Number 4, how to scan for pre-earning stocks that will run. Number 5, my favorite pre-earnings option strategy. And number 6, a real-world example and walkthrough. So let's talk about earnings seasons. A publicly traded company in the US is required to report their financial results on a quarterly basis, which means we have 4 earnings seasons per year, with each one lasting about 6 weeks while all of the companies report the previous quarter results. Stock analysts and managers typically set their guidelines and estimates to correspond to specific quarters or fiscal year endings, so the results reported by firms during earnings seasons often have a big role in their performance of the stocks. So let's talk about earnings season. Publicly traded companies in the US are required to report their financial results on a quarterly basis, which means we have 4 earnings seasons per year, with each one lasting about 6 weeks while all of the companies report the previous quarter results. Stock analysts and managers typically set their guidelines and estimates to correspond to specific quarters or fiscal year endings, so the results reported by firms during earnings season often have a big role in their performance of those stocks. In plain English, every earnings report is like a Super Bowl for the company, and it is full of hype and hope for the future. And if we can identify pre-earning runners, then we can bank some quick profits with limited risk. The key is to be smart and disciplined to find high probability trades. Buy the rumor, sell the news is a well-worn expression that simply means that if good news is expected sometime in the future, the price will move higher in anticipation of that date. A lot of stocks have a tendency to rise in the lead up to earnings due to the expectation of a positive earnings report, and every earnings season is an opportunity for this strategy. So where do we find a list of companies that are reporting earnings? A quick Google search will give you lots of options, and 3 of my favorite websites that are free are: number 1, NASDAQ.com. What I like about NASDAQ.com is that it provides a link to each stock that gives more details about their earnings and the expectations. Number 2 is Kiplinger.com, and they highlight the big name companies that are reporting. And number 3 is Yahoo.com, and they provide a list of all of the companies that are reporting. And the pay website that I really recommend is TipRanks.com, because they give you great earnings information and analyst forecasts. For example, with Nvidia, we can see they have a history of beating earnings expectations, and for pre-earnings runners, this is something we definitely want to look for. And then when we look at the analyst expectations, we can see the stock is currently trading at $242 per share, and the analyst price target is $361, so they are very bullish on this stock. TipRanks is great, and there's a special link in the description if you're interested. Here's how I like to set up these trades. I want to look for stocks that are bullish and trending up. I want to enter the trade roughly 5 to 12 days ahead of the earnings date. The more time you have, the better, but with options, we only need a small run-up to be profitable if we set up the trade correctly. Next, I want to make sure the break-even strike price is relatively close to the current stock price. We're not playing long shots. After that, we want the average daily volume to be greater than 300,000 shares daily, and this helps ensure that we've got more options and better option volume. And then I want 3 consecutive days of the stock trading higher, especially in the current market where things have been very volatile. In a less volatile market, this would be optional. And then we want to close the position before the earnings date. The pre-earnings play is very simple and straightforward. We're looking for stocks that are running up pre-earnings, and our goal is to get in and get out for some quick profits before the earnings date. When it comes to scanning for pre-earning stocks, I personally use Thinkorswim. And here's a screenshot of my TOS scan setup. For those using TOS, you can replace the Fibonacci upscan with anything you want that determines an uptrend. For example, you can replace the Fibonacci upscan with price above the 20, 50, and 100-day moving averages, and that will work well. And now let's jump into FinViz, and I'll give you a free screener that you can use. The free version is not as good as the TOS scanner I use, but it is free and still very helpful. We're now at finviz.com, and I wanted to give you guys a free scanner that you can use. So let's go over these parameters and realize there are over 400 stocks reporting this week, and we're able to size this down using this scanner to 13 different stocks for us to look at. So that's a real reasonable amount. First thing we want to change is the price or cash. We want it to be over $5. Next, we want to look at the analyst recommendations, and we want to set that to buy or better. For the earnings date, we want to set that to next week. And then for the performance, we want it to be up today, and we want it to be up on the week as well. Next, we want the price to be above the 20, the 50, and the 200-day simple moving average. And then the last thing we want to set is the average volume to be over 300,000 shares per day. And if you look in the description, I will give you guys a link to this so you don't have to fill all of this in, and that'll make it very easy. And then just with this simple scanner, we've narrowed it down to 13 different stocks using FinViz. My favorite pre-earnings option strategy is the bull call credit spread because it allows us to capture a nice profit while giving us limited risk.
All right, let's go over the bull call credit spread because this is what makes the magic happen. Our goal with this is to profit from a gradual price rise in the underlying stock, and we want to look to buy the call close to at the money, and you want to see what works best for your strategy. For the bull call spread explanation, a bull call spread consists of one long call with a lower strike price and one short call with a higher strike price. Both calls have the same underlying stock and the same expiration date. A bull call spread is established for a net debit or a net cost and profits as the underlying stock rises in price. Profit is limited if the stock price rises above the strike price of the short call, and the potential loss is limited if the stock price falls below the strike price of the long call or the lower strike. We're now looking at the bull credit spread graph, and this is on the stock we're going to use today as an example. So right now the current price is right around $23.24, and our break-even price is $24.08. So this means if the stock is higher than $24.08 on the expiration date, we're going to be making money, and if it's lower than $24.08, we're going to be losing money. And our key point here is we want these two numbers to be pretty close. If these numbers are spread out a long ways, we need a big movement in the stock price, and I call that a long shot trade. So we want this to be a high percentage trade. Next, we're going to look at our maximum profit, and a bull call spread performs best when the price of the underlying stock rises above the strike price of the short call at expiration. Therefore, the ideal forecast is modestly bullish. And then our bull call spread strategy. Bull call spreads have limited profit potential, but they cost less than buying only the lower strike call. And this is really important, the part highlighted in yellow. Since most stock price changes are small, bull call spreads in theory have a greater chance of making a larger percentage profit than buying only the lower strike call. And this is why I love this strategy so much.
And now let's do a real world walkthrough and look at the charts, then set up a bull call credit spread to show you how easy it is to do.
We're now in Thinkorswim, and our scan gave us 6 different stocks as possible pre-earnings runners. So let's just take a look at the charts real quick. Our first one here is LPI, and we can see on our short-term trend they are bullish. That's a good sign. They are up 3 days in a row. Looking at our momentum dream indicator, we can see that they are in a squeeze, and we just fired a buy signal. So these are two things that I love. Next up, we're going to take a look at NOG. And this is Northern Oil and Gas. I love energy stocks right now. They've got a revenue growth forecast of 181.7%. They're also in a squeeze, and we can see they are starting their run up right here. After that, we've got PDA, and we can see they've got a nice earnings run up going along. Plus, we are green on green, which we love to see. Next up, we've got Ruth, and this is going to be our example today, and this is exactly what we want to catch. Check out this pre-earnings run up. This is extreme, and this would have been a great one to get into early, and it might not be too late now. And I definitely want to point out that we had a squeeze going, these red dots right here, and then we picked up a buy signal as well, and we are green on green. So this was one with the exact set of circumstances that we were looking for, and it's already shot up from around $20 to $23, a real nice gain, especially in options. SSL is another possibility. Here we can see it's just now starting its run up, nothing too extreme yet. And then our last one that we want to look at is VIST, and this is another example of exactly what we're looking for with a real nice run up. Short-term trend is bullish, green on green, and a buy signal. Now looking at Ruth, and Ruth's hospitality group is Ruth Steakhouse, beautiful run up. So let's jump over to the options. We just simply click on the trade button, and we want to look at the March 18th options. And whenever I look at this, we don't have very many options trading, and I don't like the spread because it's extremely wide. So that's something that we don't want. So Ruth's is not going to work, and this is a real world example of what can happen. So even though I like the stock, I like the setup, we don't have enough options volume. So we have to go back to the drawing board. So we're going to come over to the charts. Now let's take a look at NOG, and this is Northern Oil and Gas. So we're now looking at the options, and our bull call credit spread, we're going to want to buy the 25. I'm on a Mac, so I just hover over it. It says buy, and I'm going to hit the control key and click on buy, and then we want to sell the $30 call. So we come over here, move over to the sell, we click on that, and you can see we've created our vertical, and this is our bull call vertical spread. And now if we come over and click on confirm and send, this is our order confirmation dialog box, and this gives us all of our details, and it tells us that our break-even strike price is $26.20, our maximum profit is $380, and our maximum loss is $120. So in this case, we are risking $120, and we've got the chance of gaining $380, and our break-even is $26.20, and the current stock price is $24.27. So the question we have to ask ourselves is, do we think Northern Oil and Gas is going to be above $26.20 by the time it announces earnings on February 25th? If you you think that it'll be above 26.20, this would be a great stock for a pre-earnings play. If you don't, simply look for the next one, and that's all there is to this strategy and making it work.
As always, thanks for watching. Have an awesome day. Smash that like button and subscribe if you haven't already. And if you want my indicators, free stocks, or free crypto, check out my links in the description below. Peace, and I'll see you on the next video.